Is now starting. All attendees are in listen-only mode.
Hey guys, got started a little late again. We were telling childhood stories of mine. Uh, Me falling through a plate glass door when I was a kid. So anyway, got a little outside of us. But let me give it a second just to let everybody kind of file in here. I see it's really cranking out. Just hit me up in the questions box to make sure you guys can hear me. Yeah, I probably sound a little gravelly or nasally. I've been sick for about a week now, so bear with me, please. Might have to take a few drinks of water and hopefully I don't start having a sneezing attack on you guys. All right. So without further ado, let's get this thing on the road. All right. We were saying this is going to be an intermediate area. So I broke it down into two where it's going to be beginner, intermediate. And then after about 12 of these, we're going to go into intermediate advanced. So I've kind of sectioned these out so that we're going to kind of ramp this up. These are going to get a little bit more difficult as we go along and a little bit more risk as we go further down the pipe here. So we're going to start out with some basic ones, and then, as you guys get more and more comfortable, throughout the year, we're going to get into more advanced strategies. And it doesn't always necessarily mean that there's 10 legs to this thing. It just has to do with what I've tried to weigh the balances of risk versus difficulty of understanding as well. So some of them are going to be really easy to understand that are going to be in some of the advanced areas. But, having said that, then those are going to be ones that are going to carry a little bit more risk. So we're going to be talking about that as well. Do you have anything with dynamic collars? David, let's talk about that at the end. Right now, this is a pretty basic one. And I'm going to have to take a second to read that in a second, Michael. I'll have to stop and pause, find a second to be able to read that all. So basically, we're going to try and increase our probabilities of profit using this one. This is basically wrapped around an underlying that we already have. We talked about in the previous webinar on the protective puts. Now, one thing I don't like about protective puts is that it increases your cost basis. Not a lot of people think about it that way, but it does. It's kind of like insurance on your house increases your cost basis as well. And people don't really think about that either, but it is increasing your cost basis anytime you have insurance, you're paying for insurance on something. The collar kind of negates that. We're going to build this so that the collar actually lowers our basis. We don't want to do the collar if it's going to increase our basis. All right. You might as well go and do just the protective put at that point. If we're going to limit our upside, we want to be given something in return in a sense. And that is in the form of a credit here. All right. So let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for well over 20 years now, and it's over actually 25 years now. And I'm not really going to tell you I'm going to make you rich or make you a millionaire, you guys. I'm actually here to teach you how to swim in a sense. So one of the things with the way I trade, I'm not going for those home runs. I'm not trying to be a millionaire overnight. I'm not going to throw all my eggs in one basket. I'm out there swinging for singles, doubles, and triples. Every once in a while, of course, I will throw a couple of trades on looking for a home run, but I know those are really low probability option strategies. So, those are usually, I throw those in for a little bit of protection, and if it hits, then it hits, and I'm protecting my portfolio. Similar to what this collar will do. But if you guys watch the daily market commentaries, like I put on a USO trade, bought some puts in USO, just simply on a technical move, low implied volatility, protect my portfolio if we start seeing that come down, because I'm long some oil stocks as well. So that was just buying a little bit of insurance in a sense, but I did it really small too. Anyway, I've been trading since college. I actually started trading my sophomore year in college, and I was trying to get a psychology degree. Started falling in love with it, switched over to finance, even started trading options in college, basically self-taught trading options, so I didn't really know what I was doing and when the right environment was, what the right strikes were, and stuff like that I should be trading. But I actually did pretty well with it, and then decided to move up to Chicago, started working as a trade checker, a runner, like these guys out here on the sides here. You can see some of these people are phone clerks and runners. They run the paper up to this guy right here, and then he tells me what to do. Well, I'm actually trading right now, but that's how that whole thing works. And I started out as a runner, sold all my stocks and closed out my portfolio, bought myself a badge, had some money to back myself, and been, trading my own money ever since. Let me go over a real quick disclaimer. Any opinions, news, research, and analysis or other information contained here or material provided by ProTrader Strategies or associated companies is to be provided as general commentary and should not constitute investment advice. Basically what this comes down to is I don't know what your risk parameters are. I don't know what's in your portfolios, you guys. So what I'm saying is appropriate for me may not necessarily be appropriate for you. And just take what we teach you in these webinars and daily market commentaries and things of that nature and implement it into your portfolio in your own way. The bottom line is do your own homework. Please remember the past performance of any trading system or methodology is not necessarily indicative of future results. All right. All right. With all that out of the way, one other thing, you can follow me on Twitter at Wolfman's blog, or you can follow our parent company at ProTrader Strat. All right. Can you speak? I'm going to answer Michael's question real quick before we get going here. Can you speak to exiting options trade? I was in a profitable strangle on calm, showed that the put profit. So I selected options from the menu to exit the leg out, paying attention to the LM bought for exited LMNT for one and underlying trading 39. Hey, Michael, remind me to talk to you about that at the very end, because it's not going to be really appropriate for everybody here, or you can email me. That would probably be the best way. If you guys ever have like questions on, trading and stuff like that, I am more than willing to talk to you through that on emails as well. So take advantage of that. All right. All right, cool. All right, so like I mentioned, this is the collar, and you can do this collar around an individual stock, and that's mostly what we're going to talk about. But if you have a portfolio, so let's say you have a portfolio of just mostly stocks that you've bought throughout time, let's say, and you don't want to go in there and individually hedge all those, you could use something like the SPY or the triple Qs, depending on what your weighting is. Keep that in mind. If you're very tech heavy, then you'd use the triple Qs. If you're very blue chip heavy, with you got like let's say Coke, Deere, Caterpillar, IBM, stuff like that, that's in the Dow, then you're going to have to use the Dow products or the Dow ETF. So just follow that to use this collar around the overall portfolio. It's not going to be a perfect hedge, but at the end of the day, if you don't want to do it around each individual one, then you can set it up that way with an ETF to cover the overall portfolio. And I'll show you how to figure out how many contracts you need to do to cover an overall portfolio as well. All right, but we're going to mostly be talking about this around individual stocks. All right, the collar, basically you need to be long the underlying. And the only way to make this particular strategy IRA appropriate is if you are long that particular underlying. You can set up, you can do the collar all at once where you're buying the underlying and then you do the collar as well. I mean, all at once, I mean within the same day. I don't think that, at least on TD Ameritrade, I don't think that you can actually set up a collar per se, but you can, if you're buying the underlying and you're worried about it, you can set this up all at once as well. All right, so basically we're going to be buying an out of the money put, and we're going to be looking at the 16 delta. Actually, I start out with selling the out of the money call because puts have a tendency to have a little bit more premium in them than the calls, the counterparty calls or the equal distant calls. So I look to sell the call and then buy the put, where I can finance the put with the call. Okay, that's the idea here, is we want to finance this put with this call, right? That way we do it for a credit in a sense, right? Selling the out of money call is a covered call. Correct, John. Absolutely. So basically, in a sense, what we're doing is we're taking the covered call strategy and jamming it into the protective put strategy. And we're using that covered call to pay for our protective put. Okay? And thus, it's called the collar. Does that make sense? All right, so I always do this, right, or for the most part anyway. The collar, the essentials to success is picking the right strike. Now, I talked about this. This is really for protection. We're not doing this to make a ton of money, because the collection we're getting isn't really going to be that great. Now, this is a good strategy. It's not one of my favorites, but it's a great strategy, especially around earnings. If there's an if you're at all worried about an earnings, let's say Apple, for instance. Apple's had a great run. There's been some hubbub around this Christmas season that sales weren't that great. I don't know if that's true or not, or if it's just rumors, but a lot of people talking about moving over to Android. But having said that, with the Apple, maybe you're still bullish on Apple and just want to make sure you're protected to the downside. So coming into the next earnings, you might want to put a collar around it. It will limit you to the upside, but it will protect you to the downside on an extreme move. Now, a 16 delta is not going, it's like having a stop well below the market, right? So in a sense, but you can know exactly where you're getting out. But you are going to have protection to the downside. Why the 16 delta? Is that the expected one standard deviation move? Absolutely, John, and I'm going to get into that right now. So this is the bell curve. This is, if you remember back from high school and your teacher always graded on a curve, which I always thought was ridiculous, but it is what it is. This is the one standard deviation move to the upside and one standard deviation move to the downside. And the reason why is it's a 16 delta is these all add up to basically 16. When you add up the 13.6 plus the 2.1 plus 0.1, we come up with very close to 16. So does that make sense? So 16 delta on the call or the put, and both, Chuck. So we're going to be trying to nail the 16 delta on both of them. Sometimes we're going to have to go a little bit further down the line for the put, but I'll show you how we can wiggle around that when we get to the trading platform. All right, picking the right duration. The right duration on this is basically less than 45 days, right? So I want to kind of pick in and around when I want to do this strategy. So one thing I like to do is put this on around an earning if I'm at all worried about the downside. With this strategy, you guys, we are still bullish. We would, it's a rich man's problem when you reach a one standard deviation move to the upside. That's what we ultimately want. We want the market to continue to rally, not quite reach our short call, but have this whole thing expire worthless. We get to collect that small credit and we're done. If it goes up and through us, that's a tough problem to have, right? You are still going to be able to capture some of that upside. A lot of people say, when you do that covered call or that call that's covering or limiting you to the upside, it doesn't really. Of course, if somebody, calls that stock away from you, that's a different story. But and that rarely happens until like the last week or so. You would have to worry about that. But you are still able to participate on the upside, even with that short call. It's not going to be as much as a dollar for dollar increase as the underlying goes up. But you'll be able to participate on 20 cents or so, something like that, depending on what the deltas are on the upside. As soon as those calls go really deep in the money, that's a different story. But you will still have participated a little bit on the upside. Another thing with this strategy is, let's say, for instance, we have on, so basically what I wanted to say with this one is we want a shorter duration to give ourselves less time to be wrong, in a sense. We don't want to really go way out here. Since we're collecting a credit, we want this theta contraction. We want the thief in the night theta to come and steal our premium, because we're short that premium. We want to get rid of it. So shorter duration's the best. Inside of 35 days is great. We're right now right around 40 some days. That's fine too. I usually say 45 to 35 days is a great time to get in there. Inside of like 20 days, 14 days, there is a lot of theta contraction in there, but there's also not very much premium to be had at that point. All right. So keep that in mind. And one thing about the environment, we would like to implement this strategy when there is high implied volatility. Now, because we're buying and selling them, it's going to offset one another. But the one thing about high implied volatility is that it will allow us to get a little further away from where the underlying is trading. Now, in a sense, it allows us more upside room, but keep in mind that will add more downside risk to you, because you're going to have to get a little further away from where the underlying is trading now in order to have those puts go in the money. So I have a tendency to lean towards a higher implied volatility, but it's not necessary. Okay. We don't really want implied volatility to expand on us, though, because that increases our deltas and things of that nature. So it's a gray area, to say the least. It really, we don't, the one thing I can say is you don't really want implied volatility to expand rather quickly. So like, for instance, when I was talking about having this on around earnings, you guys, for an earnings event, I would put this on relatively close to that earnings event. Within a day or two. I would usually, if the earnings come out in the afternoon, then I would probably put this trade on, or, after the close. If the earning was, let me repeat that because I said that a little out of order. If the earnings release was after the close, I would put this strategy on in that day's afternoon. And if they came out, the earnings on the next day before the open, I would do that in the previous day's afternoon. All right. So I can capture that big move. So it's going to be a big move to the upside, but you're protected if it outpaces to the downside. And a lot of times with earnings, more times than not, if you've watched any of my earnings videos, the one standard deviation move is a very rare occurrence. I mean, it says it's going to be about a 15% chance of that happening. But remember, volatility is overstated in and around those earnings events because it's a fear gauge, in a sense, is what I like to call it. As fear increases, volatility increases in it. Around an earnings event, fear is at its pinnacle for the most part, at least for most underlyings. So you're going to be able to get pretty far away on those. And if it outpaces the market maker move, which if you're selling that 16 delta, then that is a good thing as far as I'm concerned. I'm more than willing to have on that short call and be done with that stock. But that's me as well. So 16 delta, is it in the money or out of the money? 16 delta is out of the money. Anything above 50 delta is in the money for the most part, as a ballpark. So anything greater than 50 delta is in the money for the puts or the call. Anything less than 50 delta is generally out of the money. Does that make sense? But isn't giving the tall part of the bell curve, but isn't going to be the tail part of the bell curve 3 standard deviations? The very end of that bell curve was 3 standard deviations, yes. And that's only like a 1% chance. That's like a 1 delta kind of thing. or less than a 1. It should be less than a 1 delta, but they don't do that. Here we go. So this is what we're looking at. So one standard deviation line right here is basically all of this area combined. That's a 1 standard deviation. If it goes above this, it's a 1 standard deviation move, 2 standard deviation move. But the deltas add all of that in. So you add 13.6, 2.1, that gives us 15.7, 15.8. And, you know, there's still a couple more percentage points here. It basically gets you up to 16. Okay. Same thing to the downside. If we looked at, well, this is actually the call side over here, but this is the put side because it's negative. Right. So that's what we're trying to, you know, we're trying to, you know, stay inside of here because this is the high probability, right? Even on earnings, they stay inside of here quite often. Right. All right. So picking the right underlying, you know, this is pretty basic, you guys. My basic rule with picking the right underlying is, you know, everybody has all kinds of stocks in their portfolio, right? If you have Aon in your portfolio, you probably want to be weary of throwing options around that particular underlying because the bid ask in those is so wide. So when we're trading this strategy, my rule is that the bid ask on the option montage should be no more than 10 cents wide. So let's look at something. I don't know, what do I have up here? Coke. So Coke. So the bid ask, any stock under $100 should have a bid ask less than 10 cents. That means on the calls and the puts, on the nearest expiration is usually where I go to start looking at this. Between the bid and ask should be less than 10 cents wide. And as you can see here, they're like 2-3 cents wide on a stock under $100. Any stock over $100, let's say, for instance, EA Sports, or we could even say Apple. Let's look at Apple. So, for instance, with Apple, you know, it's a $100 stock. So what I say for a stock over $100. So a stock over $100, I say take the decimal point, move it 3 ticks to the left, and that's how wide it should be. So for Apple, it should be less than 17 cents wide. Now, Apple's 3 cents wide as well, which is pretty good. You know, Pepsi being over $100 stock, you can see that Pepsi is inside of that 11 cents wide. So that makes that stock good. We can look at JP Morgan as well. Should be, you know, 10 cents wide because it's over $100 stock. If it's a $300 stock, it's 30 cents wide. Okay. Does that make sense for everybody? Any stock under $100, we want no more than 10 cents wide. Any stock over $100, just move the decimal 3 ticks to the left, and that's how wide it should be as a rule of thumb. You get into the $1,000 stock, you know, like Priceline or something like that. You know, that's going to be like $1.80 wide. Okay. And Priceline usually fits within that rule. It's pretty wide. They're usually about $1.50 wide, but you know, it's over $1,000, almost a $2,000 stock. And the reason why you guys, like on some stocks, if you guys are trading stocks that nobody else is in there trading, when there's no volume and open interest, that means there's like one market maker in there. And if he's the only guy, you know, that you can buy water from, he can charge you whatever he wants, right? He knows you need the water. All right. So it's a similar situation in options. If he's the only guy, you know, buying and selling those options, then you got to basically pay his price. When you go into Apple or you go into some of these other stocks like Pepsi or Apple or Coke or Deere or, you know, Caterpillar, there's so many people in there trading on a daily basis that people start giving up the edge, right? You know, when I go into the option market, I don't just usually sit on the bid. I usually give up a penny. I'm like, I'll give up a penny to get the fill. You know, that was one thing we used to say on the floor. Do you want the penny or do you want the fill? Give up a penny and you better the market. Somebody else comes up, betters the market a little bit, and it makes those markets a little bit tighter. And then somebody steps in front of me because they were like, that guy just took mine, took my market and steps in front of me, so then those markets become very tight. That's when there's a lot of participation, a lot of different people wanting to get their trade off. That's what the free market is about, right? But some of these other stocks, it gets really wide, and you might have to give up a quarter to get in and 25 cents to get in and 25 cents to get out, and basically you're at a scratch, even though you were in this for almost a month. Took all that risk for nothing. All right, knowing our exit strategy, okay? Usually I'm going to ride this one out, and you have to decide whether or not you want to get out of this. I'm not one that holds stocks for long term. One thing I've gotten away from is holding stocks. When I started trading in college, of course, I bought stocks and I traded around those all the time. I was selling calls, getting out of them, and then I'd wait for it to come back and I'd buy the underlying again. I didn't know about selling puts at that point in time. I was just doing covered calls all the time. But and I wanted those stocks. I've kind of gotten away from that now. It's like if I have a stock in my portfolio, it's because I'm trying to lower the basis on a stock that got put to me or something like that. So I don't like to hold stocks for a long time because, for one, to me, that's just margin wasted that I could be using elsewhere in trading and making more money. So I'd rather use the leverage somewhere else. But I usually, if I have stocks in my portfolio, it's because I'm trying to get back to profitability with that. So you're going to have to decide whether or not you really want to get out of this early. Like I mentioned, if it goes through your calls that you participated on the market move all the way up to where that short call is, if you don't want it to get called away from you, get out of that strategy, okay? And you're going to have a loser on that strategy. It doesn't increase your basis, though, you guys. Don't think of it as increasing your basis on that at that point. But you didn't get to participate on that move between the short calls and where you got out is what you're going to be thinking about. You did miss out on opportunity there. But I always look at it like, hey, it moves to a 16 delta 85% of the time. That's not going to happen. So the probabilities just beat me. I would be willing to let go of the stock myself and wait for a pullback. Maybe go and start selling puts at the level I wanted to buy the stock at now. Because usually if it makes that big move within the short duration of time that we're going to be looking at, that means the probabilities went against you. There's probably going to be a pullback as people start to say, oh my gosh, this had a big move and I'm ready to take some profit. So to me, I just let it ride, let them take my stock away from me. But you need to decide whether or not that's going to, hurt you on tax implications and things of that nature as well. I'm not an accountant and I'm not allowed to give tax advice, but you're going to have to really think about that as well. All right. But I always look at it like if my stock gets called away from me, start selling puts. And then, that's collection of premium every 35 days until the market comes back down there, and then somebody puts the stock to you, and then now you're long that stock at the level you wanted to be. Okay. All right. So max profit is the short call strike minus the underlying price plus the premium, right? And when we pull out the platform, we'll go through this in a little bit more detail, but as a matter here, I'll just pull it up right now. So it's pretty easy. The underlying, so we're going to be looking at, let's just say we're looking at JP Morgan. We own JP Morgan, and it's the max, so it's traded at 108. We would be looking at like the 16 delta, which just happens to be right here. 16 delta is 113, and then we look at the 16 deltas down here. So we're collecting 40 cents, let's say, because that's middle market. Let's just say if we collected 40 cents, we'd have to go down here and probably sell these so that we get a credit. So the 103. So we're at the 103, 113. And as you can tell, it's 5 to the up and then basically 5 to the downside. So it's pretty darn close. All right, so the 113s, we're collecting 40 cents. And then 103s, we're buying them for about 32 cents. So a total of 8-cent credit, let's just say. Right, so we got an 8-cent credit on those strikes if we were to build it out. So our short call strike is a 113 minus the underlying price, which is 108. So 113 minus 8, or 108, gives us 5 plus the premium, because we get to add that in, 5, because it's a $5 move in a sense. What you're thinking is the underlying moves all the way to that short call strike. That's a $5 move, right? You get to get that $5 move. So you made $5 plus the 8 cents. So $5.08 on the upside would be your max profit. All right, your max loss is going to be the underlying price minus the long put. So in our example, it's traded at 108. Our long put is 103. So our max loss is going to be 108 minus 103, which gives us 5 minus the premium, because that was a collection. So our max loss is $4.92, right? So we set a collection of 8 cents off the top of my head. And then our break even is going to be the underlying price minus the premium. That's our break even. So where the underlying is trading minus the premium, because the premium is a collection. So our underlying, when we set this strategy up, our break even is actually slightly below where our underlying is going to be currently trading, because we got a collection. Does that make sense? Because we lowered our basis, you can also think about it. We aren't actually owning this at where we, let's say we bought it at 108 and we collected an 8-cent premium. We actually bought this at 107.92 because we collected a premium. We collected a premium, lowering our basis. Does that make sense? John's asking, where would the underlying be on the bell curve when that original one was set up? It's right in the middle. Whenever you set up a strategy, all things being equal, when you first get into any strategy and options, the bell curve is at 0. Okay, this is where you're getting in. And then this is your probabilities throughout the remaining time of that option. And that's why I was mentioning, anything above, when I was talking about the deltas, anything in the money is going to be slightly above 50. Anything in the money is going to be slightly above 50. Anything out of the money is slightly below 50, because right here, everything is a 50-50 chance. If we were, the underlying was pinned at 108 even, which is, very difficult to find, then those 108 calls would be a 50 delta. So would the puts. Yeah, so 0 is at the money, 0 standard deviation. And the reason why is because it's 50-50 in either direction, which is your probability. When you go out and buy a stock, you have a 50-50 chance, despite the fact that we've been in an upward channel for the equities for the past several years. Your chances when you buy that stock are actually 50-50. So you can flip a coin whether or not you were right when you bought it. So the only way to increase your probabilities of success is to lower your basis and to trade options in and around it. Okay? All right, so this is usually when I kind of throw it out to you guys. We'll go over some of your guys' examples. So throw it out to me in the chat window. Or sorry, not in the chat window. I'm not looking at the chat window right now. Throw it out to me in the questions box. That's how we're going to communicate back and forth throughout this whole thing. So, throw out some stocks that you are bullish in, but you're worried about the downside. And we'll go over some of the rules in and around that. All right, Amgen. All right, Amgen, Boeing. All right, got a couple of them flying up here. Perfect. So let's look at, first one I saw was Amgen. Oh, you guys are blowing me up. Love it. Strategy for calm earnings report. They had the earnings already. Michael, is that what you're saying? All right, so Amgen. I always look at the charts too, and we kind of want to go. We don't want all these long duration ones. Depending on when their earnings are, which could be relatively soon. Let me just pull up another chart just so I can see where the earnings are. So Amgen is having earnings in this particular one. So, we are coming back into earnings season after this 14 days of January contract. All of the February are going to be including them. But just to keep in mind, with this earnings here, I would probably set this on, for instance, they come out with their earnings on the aftermarket on the 1st of February, okay? So I would put this strategy on Amgen probably right around the 1st in the afternoon, okay? If I wanted to do it now and get it out of the way, I don't really have a problem with you going to like the 14 days, but just to be sure, I don't want to have any confusion that if I started looking at this, that I'm missing the fact that there is earnings in there, okay? So I'm not going to be taking into account earnings every time I look at these right now, because I think a lot of earnings are going to be falling in this February contract. But for that, I would like to get the inside of 45 to 35 days to kind of get this, because you can get pretty far away. But for this, because we saw there's earnings, maybe I just want to do this for a short duration. Amgen, $180 stock, right? 3 ticks to the left should be 18 cents wide. And it fits that bill, inside of 18 cents wide, right? We got 8 cents wide, we got 9 cents wide. So Amgen fits that rule of a stock over $100, move the decimal 3 ticks to the left. We've got 18 cents wide. It's well inside of 18 cents. So that fits the rule. We like to see high implied volatility. It does meet that. Most of that has to do with the earnings though. That high implied volatility allows me to get a little further away from where the current underlying is trading. All right. So we would want to start out with looking at the calls. I can look at this and say, okay, I can probably get about 60 cents, maybe 59 cents. So I want to look over at the 16 deltas. So 60 cents, if I collected 60 cents, I would have to sell the 72 and a halves. All right. So I'm selling the 87 and a halves. 7.5 to the upside and basically 7.5 to the downside. So that works. So I would go in. And so for instance, whoever Greg was said that the example for Amgen for us. All right. For instance, if I only owned 100 shares of stock, I'd probably still do this 1-to-1 because remember, options have 100 of the underlying for every one contract. That's what we're hedging. Anytime you do a one lot in the options, that's worth 100 of the underlying. If I had 500 Amgen, okay, I would probably still only hedge maybe 3 of these, 3 contracts. All right. I don't want to hedge the entire thing because if I'm worried that much about the downside on this, but I always like to leave a couple of them on in case it blasts through my upside. All right. If I'm worried about it going down to the downside that bad, I'd probably get out of it, to be quite honest, if I was that worried about the downside. So I always look at this kind of like what I was talking about with the covered call strategy, under hedge the quantity that you're hedging, So we're looking to take a little bit less than that 1-to-1 in a sense. Does that make sense? So if I had like 500, I'd probably do 3. If I had 1,000, I might do like 5, maybe 6. Okay. Oh, Rick's in. Rick, Rick said he just was sent the correct webinar login link. I told them to send you specifically the wrong one, Rick. I'm just kidding. All right. So Next, so does that make sense, Greg? So that's what I would do with that. So, depending on how many you would have with this, start with the calls, and I would skip out of that earnings, because then you let this one expire, get out of there before earnings, and then earnings, you're going to be able to, like, just note that with the 14 days to go, we got $7 outside, wasn't it $7? Yeah, $7 higher, and $7, a little bit more than $7 to the downside. But during earnings, I bet you're going to be like almost $14 away to the upside and 14 to the downside. Okay, so you are going to be having a little bit more risk to the downside during that earnings. But, if it goes, below that one standard deviation move to the downside, you're going to be happy that you got out, right? Because usually that's a pretty bad sign, especially to the downside. The upside, what I've noticed is a lot of times when these things gap to the upside, everybody takes profit and it comes down. When it gaps to the downside, everybody pukes and it just keeps going down. So a lot of times, you'll have to dig into the earnings as well. But a lot of times the downside keeps going down, and to the upside, they come back down shortly after. What put do you buy for Amgen? So basically, I just make sure that I can pay for it. So I would be going in and say I had 1,000. Let's say I had 500 Amgen. Okay, so I would sell this one. I know I can probably get 60 cents for it. So that's what I'm looking to pay, for 60 cents, and then buy this. I better get a credit. So it's a small credit. It's not much. But one thing also, this is at the mid-market. We've got almost 10 cents wide here, almost 10 cents wide here. There's a lot of volume and open interest in here, I bet, where there's a lot of traders. A lot of these contracts are being traded, a lot of open interest, a lot of volume on a daily basis, a lot of open interest. So there's people in here watching this. Don't ever enter in. I got mad. What trade was it? I can't remember what it was, but I put a trade in like 2 cents above the market and got filled like immediately. I get mad every time. If I put this order in right now, it's saying I'm mid-market. If I put this order in right now and I got filled, I'd be mad at myself. And the reason why is because I know I gave up some edge. So if I had 500 contracts on, I'd probably do 3. If I had 1,000 contracts of the underlying long, then I'd probably do maybe 5 or 6. So I don't want to take all of it. But anyway, for what I was saying with this, mid-market is 4 cents to the upside. Don't ever do this for a debit. If you have to do this for a debit, don't do it. A scratch or more. But this says mid-market's 4 cents. I'd probably go 2-3 cents above. Put that in the market. Let it sit for a second. I'm not saying let it sit forever, but let it sit for a second. It doesn't cost you anything to go in and send this order out. Let it go in there, because what happens a lot of times, there's all kinds of spreads going on in here that you can't see. All of these letters are next to the bid ask are different exchanges. All right. So one exchange might have a better market than this exchange. Okay. Or, so the I exchange might be at 57 cents or something. But there's also, the computers do auto lagging. Okay. What that means is if it, finds an offer, it'll buy that offer and then it'll leg you in like immediately, as long as it knows it can get those. All right. The other thing is, what I know I was a spreader in the Fed funds. All right. So I know that auto spreaders, those machines that do the spreading for you, can't lean on a market that's leaning. So that means a spread can't lean on a spread leg, in a sense. I don't want to go into too much detail with that right now, but if it can't lean on a leg, then it doesn't show that leg. And if you know what all the spreads are, then you can kind of piece that together, which is what I was good at when I was on the floor. But you can't always see where the exact bid offer is what I'm saying. So the market might be much tighter than what you think you're seeing. So it doesn't cost you anything to go in a little bit higher than mid-market, and if you're buying a little bit lower, and put that in, Then by the time you go up, cancel, replace that trade, cancel, adjust the price, hit enter again, wait a couple of seconds, go in there, cancel, replace, and go back to the mid-market, and then let it sit for a minute. That way you've captured all those pennies. And those pennies don't seem like much, for this one trade. But if you do this over the course of your life of trading or over the course of a year, it's going to make a lot of sense. You're going to be able to, think about it. If you got a couple extra pennies on a particular trade, that could have paid for the commissions, right? Which is everybody's bane. Nobody likes to pay commissions. So if you do it better, then you're off to the races. And if you put it in where it's just the legs that you're seeing, then it doesn't give those auto leggers enough time to line everything up. Even though it's, they can do it very fast. It just doesn't give them enough time. Okay. Would it make sense to add another 50 IV% for the stock as other conditions, since we want high volatility? You don't have to have high volatility. The real thing here is we just don't want volatility to start really expanding on us. Okay. Does that make sense? All right. And Chuck, I think I answered your question, right, with what are the strikes for the Amgen example. If you had 500-ish, would you do 5 LP and 3 short call, long put, 3 short call? I probably wouldn't, David, because I don't like to increase my basis, but you could. You're financing 2 of the 5. You can play around with that and check it out, but I would usually do it. If I was that worried about the downside, then I'd probably get out of them in a sense. But that's kind of my thing, is I don't want to increase what I paid for the underlying, but you are synthetically doing if you're doing this for a debit. Don't want to expire option. Greg, February 1st is Amgen's. So in this case, we want these to expire before that. And then during that earnings event, like that day, February 1st in the afternoon is when I would put this collar on again. Okay. Oh, Shady Tree's got a trader hack for you. If you look at the volume profile and open interest columns as market profile indicator, way cool way you train your eye to see the patterns. Hope you helps, buddy. And volume and monkey bars on the trade tab. Wait, on the trade tab, you get volume profile on the trade tab? Send me something about that. That does sound cool. I would like to see that if you're talking about in the option montage. But yes, I do know that what Shady Tree is talking about is this volume profile here, and you can actually set it up to where you can see the quantities when you zoom in on it. Right now, the way I have it set it up, it just has the time brackets on there. So the blue outline is the volume, and those little numbers in there are 30-minute increments of time. They switch over. So it kind of tells you where all the volume is being traded and where the most time Amgen has spent. And the idea is that when it gets over here, it gets a little overextended because the longs want to cover it and it wants to go right back to here. If it gets overextended to the downside, it wants to come back. So where do you find a 16 delta? I have E-Trade. So on your option montage, the delta, delta gamma, it's not always going to have a 16 delta. For instance, if we looked out here on Amgen here, it's a 14 delta. So it's not always exact. All right. So, but that's our starting point. And I will usually go further away to a smaller delta to get further away from it because I want to capture that up move. So you just kind of start shooting for that 16 delta, and then outside of one standard deviation move is kind of what we're shooting for there. Does that make sense? And then whatever we can do that we can pay for with that. So on this one, 81 cents, I'd just go over here and say, okay, well, I can't sell that put, or I can't buy that put with 81 cents, but I can buy this put with 81 cents. Does that make sense? So I start with the calls, 16 delta, and then if there's not a 16 delta, I go to look for a 15, 14, something like that, okay? And then whatever premium I can get, I collect. Then I go over here and I go, all right, where can I spend my 80 cents and still have some change? The 30 minutes in the volume profile is related to what? The 30-minute, it has to do with psychology, John. And you know, I mentioned in the beginning, that's why I love market profiles, because it tells you the psychology of the market. It tells you where people are putting their money where their mouth is, in a sense. So, you know, where the most time and volume has been spent, that's where the comfort zone is, right? That's like the comfort food. It's where everybody's long and everybody's short and everybody's happy. And then when it gets a little overextended, the longs are thinking, I need to cover, and the shorts are thinking, I need to puke. And then all of a sudden, the longs start covering and shorts get, you know, puke out, and the market comes back down. And it comes right back down to the point of control. And it doesn't always happen just like that, but that's the idea, is the longs want to cover, and when that pressure puts downward pressure, then it goes to the market profile point of control. And then, you know, a lot of times then those shorts are like, oh my God, I don't want to see that again, and I get out, right? Does that make sense? Should you add protective put on the poor man's covered calls long? Not on a poor man's covered call, because you have, Chuck, on a poor man covered call, you have a synthetic long put in that strategy. And I can talk to you a little bit more about that at the end there, but I want to try and stay on task here. So are you saying that we should choose strikes and the date as a calendar or a diagonal, or take? No, I'm not saying do it as a diagonal. I'm just saying take into account where the earnings are. So for this one, the earnings are falling right here. So if I were to do this strategy today around Amgen, you know, heading into earnings, the volatility is going to increase the closer we get to that earnings event, or a binary event is what we call it. So any binary event is a known event that's going to cause volatility to increase. So if I did this strategy today with these strikes, you know, and all other things being equal, you know, we got theta decay going on and stuff like that, but we get closer to that earnings event, volatility is going to start rapidly increasing. And as volatility rapidly increases, that causes the calls and puts to increase in premium, okay? And as the premium increases, it also affects the delta. So all of a sudden, if we didn't move but volatility started spiking, this delta could be like a 20 some odd delta, right? So now we've lowered our probabilities of success. We were only at about an 80% probability, whereas before we were at an 85. And it could go to like 25. So now we're at a 75% probability of success. And if it's at a 25 delta, then that means we're probably inside what the market is predicting as a move for that earnings, okay? Because usually it's right around one standard deviation is where the market's predicting, you know, the max move could be. We would like to be outside of that. So delta tells you a lot of things that I've actually done a lot of videos on, just delta alone. But we want to stay outside of that one standard deviation move. And if volatility starts expanding on us rapidly, even if nothing else changes, then we are in jeopardy of our probabilities decreasing for our success. Does that make sense? So that's why I would like to do it in here, let that one expire, and then maybe right around earnings, put it on then. And you can do it right after earnings too. if you were worried about it as well. But I wouldn't do it well in advance of the earnings. Does that make sense? Oh, that's because sorry about that. I sneezed and I shut off my volume for a second. Sorry about that, guys. I didn't want to blast the microphone with my sneeze, so I shut it off for a second and I thought I clicked it back on and it didn't work. So sorry. Sorry to freak everybody out. So John, who is asking about the one? Dan asked about this one standard deviation. So this is also probability of something happening going outside of this, okay? So delta also tells us the probability of our underlying trading to that point, okay? I mean, from the time of inception. So when we're talking about when we implement this, we're at 0. It's a 50-50 probability in either direction because all of these percentages add up 50 to the upside, 50 to the downside, right? So everything's 50-50 when we set it up. We want the probabilities to be in our favor. So when we're selling those calls, you add up all of these probabilities and that comes up to very close to 16, right? So there's only a 16% probability the underlying will land here during the cycle that we're in, whatever days to expiration. There's only a 16 probability there, a 16 probability here, all right? So it's a pretty high probability of success strategy that we aren't going to be breached on either one of them. So delta is the probability of being 1 penny in the money at expiration of the contract. Okay, so that's why we're trying to pick that 16 deltas. It's a 1 standard deviation move. I explained that well enough for everybody? Would you have saved you on the March and July Amgen drops? Thanks. Would this have saved you on the March and the Amgen? Let's see. Let's see if I can squish this back. I mean, you know what? I don't know what the market maker move was, but I would have to say that it probably would have helped you there for sure. Because I would think that Amgen going from, what is that, 182 to opening up, well, 182 to here if you would have left it on, so $10, I would think that Amgen would have been outside the market maker move for there. And then it wouldn't have saved you here because you snapped down and came back, right? But here surely would have on the downside. But you know, your put would have probably been in here, so it may have saved you of half the fall. Does that make sense? Should the put and the call have the same expiration? Yes, they should have the same expiration. That was a great question. Yes. The only reason why I was looking at different expirations on this one was because they have an earnings here. And I would like to be out about 45 days because it does allow me to get a little further away. As you can see, like the 14 delta here is 195, and up here we're looking at, you know, a 16 delta is 170 or 187, right? There's only 14 days left in a $7 move. is possible, but it's a low probability. I just like to get, further away. But I wouldn't want to implement this today because as volatility expands, these premiums are going to expand and the deltas are going to expand as well. So I would be able to get further away for basically the same thing. Does that make sense for everybody there? Okay. All right, so this is our deal for this week, you guys. It's basically how to trade options like the Wolfman, how to set up the market profile, trade it. Protecting your portfolio against rising interest rates is a great one. Oh, you know what? I forgot to tell you guys about how to use this strategy to protect a full portfolio. So I'll tell you about that in just a second when I get done with this, because that was something I was going to do. I got to find I accidentally missed one of my slides there. All right, so how to trade options using gamma, things of that nature, history of options. This is a great one, you guys. I teach how to trade probabilities of success, how to increase those probabilities of success. Just like with this strategy, when is the right time to put this strategy on? You wouldn't want to do this 2-3 weeks before an earnings event because of that volatility expansion. And those are things that you aren't going to learn online, you guys. I mean, you can go online and figure out how to do a collar, but they're just not going to tell you those little nuances of things that we learned on the floor. Those are the pitfalls that we went through on the floor, that we kind of had to trade in and around. That's why when I get put stock, I trade around that because that's what we had to do on the floor to make money. That was our job. We knew a lot of times that when we did trades, it was not the opportune time to be doing that trade, but as market makers, we had to do it. That was our job. So, I teach you guys those pitfalls that we knew we were stepping into a trap, but, because we're market makers, we knew that we had to do it. But having done that, I've learned how to, come back from that and stay mechanical and things of that nature. So the best way to become a better trader is constantly learn, you guys, which you guys have clearly done by taking this. But wouldn't you say that just knowing how to do an option strategy isn't enough to increase your probabilities of success? I mean, there you go. I forgot to put that in there. So I put a link. Somebody asked, how do I click on this link? I don't have a fancy thing for you guys to click on the thing, but in the chat window over there, I have this link that you can go into the chat window. We're on the questions box here, but over there on your GoToWebinar thing, there's a little window there for a chat. And I threw that link for this in there. And if you're watching this on tape delay, you can just pause this and type this into your URL. All right, but anyway, so basically just trading with the knowledge of knowing how to set up a strategy, selling an out of the money call, buying an out of the money put, done. Well, that's not all you really need to know. And every single strategy I go through these little nuances with you. So I teach you that, how to play the probabilities and when and where the probabilities have gone against us, how we stay mechanical to increase those probabilities even further, all right, which is ultimately going to make you much more successful. And when you're using the right tools in the right situation, you're going to be in a more productive state of mind. You're going to be able to put on more strategies, which creates more opportunities. Remember, if you're able to put on a lot more strategies and know what your probabilities of success are, you're going to be able to sleep at night, all right? You're going to create more opportunities. That's going to build confidence and ultimately make you a successful trader, all right? So we're offering this trial for you guys today. I suggest you guys all sign up for it. What do you say? Go ahead and click on that. And if you learned anything from me at all today, you guys should be trading with this knowledge. So take advantage of that for sure. And I'll do the thank you real quick, and then I'll go to this real quick before I go to the thank you. I got a couple questions coming up too also. Was the call a covered call or a call credit spread? I'm not sure what we're talking about, Chuck. On the covered, I did a covered call strategy. This is kind of like a covered call strategy with a protective put jammed in there, in a sense. One quick question on using the 16 delta. If we look at the bell curve, has a move beyond 34% on the high side and 34% to the low side, right? Yeah, because it's a 50-50 chance on going in either direction, right? So it's a, you take a 34% plus that 16%, that's 50% to the one side and 50% to the downside. Now, what usually happens is you have a high probability of it being inside of those two, right? Those two 34%, because it's almost 68%, right? So almost a 70% probability it's going to stay within that area. And, if you can do it around higher implied volatility, believe it or not, your probabilities are even better than just those numbers, because volatility usually overstates the fear factor. When you're scared, you aren't necessarily as reasonable as you would be if you weren't scared, right? So keep that in mind as well. That's the beauty in volatility. It usually overstates it, which causes the market to price in a bigger move than what's really expected. Okay. The call you're selling is a covered call. Yes, Chuck, that is correct. And then the put you're buying is basically the protective put. Difference between selling a call and buying the put. The difference between selling the call and buying the put, selling the call, your stock is going to get taken away from you, all right? And then buying the put means that you give your stock away at the strike that you implemented. So if I sold, if I was long the example that we were given with Amgen, and I don't even remember what Amgen prices were now. So for instance, if Amgen went up, because when you're selling an option, you're collecting premium, right? The buyer of an option has the right but not the obligation to execute that contract. So if I buy calls, that means I can take your stock away from you. When you're selling calls, that means you're at risk of having to supply those stock to the person. So when we're long the stock, if it goes up and hits my short calls, well, that's basically where I was willing to sell it. It's kind of like if you just had an open order to sell your stock at a certain level if it ever got up there. That's kind of what we're doing with that short call. But when you're buying a put, now you have the right but not the obligation to put it to somebody, which means you put your stock to somebody in a sense. So if it goes down there and the trades to 72.5, well, I can basically, if it goes down to 72.5, the market goes down and it's even trading at 155. Basically, that person is buying my stock from me at 172.5. Like, here you go. So that's the beauty in this, especially around earnings, because if you get a massive move like that down to here, a stop, if you had a stop loss in there, basically the stop loss would execute you down here. Whereas the option, that if it stays down here at expiration, if it's trading down here, I'm riding this thing out and I'll just put it to the guy at this price and then maybe go back and buy it down here. You could also get out of these and for a profit and then just go with that as well, which is probably what I would do. So I don't have to pay all the costs that go in and around doing that transaction. It's a lot cheaper to get out of your puts and then get out of these puts here, pay those commissions, and then buy the stock outright or something like that. Rather than, giving somebody the stock, paying those commissions, going out and buying the stock for those commissions. Does that make sense? All right, so that's the beauty in that. When you're buying an option, you have the right but not the obligation. When you're selling an option, you kind of have the obligation, but you get paid for supplying that. All right, so this is the portfolio protection with options that I forgot to talk about. If you had a full, I mentioned this at the very beginning, like if you had a tech heavy stock or something like that, or a tech heavy portfolio, you'd use the triple Qs here. But basically, and I just went off of today's price here, right around 273. All right. But basically, whatever your portfolio value is, you take the strike price times 100, and that should give you how many contracts you should do. So if you had a $100,000 portfolio, SPY is trading at 273 times 100. Basically, when you divide all that out, you'd be doing like 3.66 contracts. Now, I'd probably do 1 or 2 at best. But this is the formula. You guys can write that down if you wanted to hedge a portfolio with this strategy. All right. All right, great. In later webinars, you guys, I'm going to be drilling down on option components, how I trade options, trades I find, when and where I find them appropriate. Also, here's the link. If you're watching this on tape delay, it's not an active link. You're going to have to pause your video here and type that in. I want to thank you guys all for watching. You guys have any questions, contact us at 310-598-6677, or you can email us at trading@protraderstrategies.com. All right. That's about all I got for you guys. If you can't take that, take it easy. All right. Enjoy your weekend, Rick. Sorry about the snafu. 3.66 of the SPY. You would do that with 3.66 SPY contracts. That's your gauge. So, you wouldn't want to do necessarily 4 because you're over hedging. So I'd probably do less than 3 just to kind of under hedge the SPY. You'd go to the 16 delta contracts as well. All right. So if I sell a put and contract is executed, I get the stock at a huge discount. Well, you get the stock at that price. All right. But you got to remember, you're going to be selling this put, a couple of months in a row, most likely. So that's what I started doing also with stocks was, when I moved to Chicago, I still have my portfolio as a runner, started learning more about options from the floor. I actually was still doing this covered call strategy and it was always with IBM and Walmart. IBM would go up to a certain level. I'd let the stock get called away from me. Of course, in hindsight, I probably should have been trading out of those. I've learned from that. But when the stock would dip back down, then I'd buy the stock. Well, then somebody was like, just start selling puts at where you would want to buy IBM, which was right around $95 at the time. I'd let IBM go up to like 105, 110. That's where I'd be selling my calls. And it always just kept going back down to like 89, 90, 95 and bounce. It was just like always just towing that $100 line for like a year or so, or more than a year, it seemed like. And that I was just selling calls, let it get called away from me, start selling puts. And then if it got down there, then I would get the stock again. And if I didn't get down there, I got to keep the premium. Does that make sense? So if you ever want to buy a stock at a certain level, you guys, don't go just put an open order in the market to buy, say, Apple at 150. I mean, go in there and just start selling premium. Apple 150 premiums aren't going to give you that much, but if that's where you wanted to buy the stock, we could look at it because it's like $25 low. But if I wanted to sell Apple puts to buy it, probably go a little bit further out. But if I wanted to sell Apple puts, yeah, that would actually be perfect. Collect 45 cents every 45 days. And if it gets down there and I wanted to buy Apple at 150, I would do that all day long. Well, not all day. I would do it every several months or every couple of months, right? Appreciate the kind words, Andrew. Take it easy, JQ. All right. Happy New Year. Happy New Year, Ted. Thank you. Appreciate it. Yeah, so you'd buy 3.66 puts and sell 3.66 calls at the 16 delta. but I would go under protection. I would go, I mean, just because I would be a little bit more bullish right now, and I wouldn't want that risk of the point, 3, 4, right? So I'd under hedge. Because my stock, if it goes up a lot, then I would want to participate on that upside also. So I would probably do maybe 1 or 2. Does that make sense? Yeah, and then it would be closer to 8 for double that. Yeah. All right. Selling puts requires large margin. Yes, it does. So, and especially in an IRA, because what they're expecting is that you're going to have to buy that stock at that level. But that's, I'm willing to take that risk for sure. JQ is getting blasted with cold in New York City. I heard you guys got the massive storm. Sorry to hear that. I'm sweating in my office right now, though. No. All right, guys. Stay warm up north. Take care. I hope everybody has a great new year. Take care, guys. Sunny and 65 here in, Michael, I don't know how to say that. Chihuahua? Chihuahua? Chihuahua, Mexico? See. Cool. Canada, negative 25 degrees. Toronto. Ugh. Thanks, Sean. 75 here, guys. Sorry. All right, guys. Take care. Have a great weekend. 73 in San Diego. Surf's up, Chris. Chris, I used to surf Lake Michigan. I had 2 surfboards in my garage. My wife's like, why do you have surfboards? You live in the desert now. Like, for when I go to San Diego. They're actually specially designed for,